Welcome back. Today we will talk about the dynamics involved in the pricing of options. As we know, options are derivative instruments. Their value depends on the yield of the underlying, not only on the current yield, but also on the expected yield. The option pricing formula is based on a model of three mathematicians economists Black, Sholes and Merton, simply called the Black and Sholes model, who were awarded the Nobel Prize. This model shows the factors that affect the price of an option are the current price of the underlying, the strike price, expiration date, interest rate, dividends, volatility. The underlying price and the strike price contribute to the intrinsic value of an option. The expiration date directly affects the time value. The interest rate also affects the price of an option. If the interest rate increases, the premiums of call options will tend to increase. In practice, there is a direct relationship for calls and an inverse relationship for puts. Dividends, on the other hand, affect stock options and not futures nor total return indices, as only stocks are subject to dividend payments. In fact, we know that, after the dividend distribution, the price of the stock tends to fall, and therefore the value of the puts rises, while the value of the calls falls. But, by far, the most important parameter that influences the price of options is volatility. Volatility generates huge opportunities for the options trader and offers the best profit potential. In fact, any misjudgment on this fundamental parameter can create problems for any portfolio. Volatility represents the measure of the price movements of the underlying. To measure it, statistical tools such as standard deviation are used, whose symbol is sigma. Strong price fluctuations give rise to an increase in volatility, small fluctuations instead mean low volatility. The larger the movements of the underlying, the higher the probability that a certain option can become in the money. The lower the movements of the underlying within a given period of time, the greater the chance that options will expire worthless. Therefore, the perception and expectation of the future movements of the underlying, that is, in fact, the volatility, will assume a great importance for the options trader. The market thrives on expectations. There are many factors capable of influencing the prices of options. The problem is that these factors cannot be predicted or quantified a priori. Expectations affect both the movements of the underlying and the variations in volatility. The degree of momentum and speed with which they develop can greatly amplify the variations in volatility and the variations in the price of the options. An example above all is represented by the moments preceding the release of important macroeconomic data. It is clear that the success of an options strategy cannot be separated from the knowledge and management of the volatility parameter. If we go on the market and take the price of any option, we can calculate the implied volatility backwards, that is, the implied volatility included in the price, the volatility that the market is pricing at that moment for those options. As these factors vary, the corresponding options on the market will have a different implied volatility and consequently a different price. If we take the prices of all the options of the same expiry, the so-called chain, and if we retrieve backwards the implied volatility of each one and connect the dots, we come at the volatility curve, also called the smile or volatility skew. This is a curve that combines all the implied volatilities of the options related to that chain at an expiration date. The shape is just that of a smile. Let's look at the example. We take the price of the call and put options with 40 days to expiry, strike 1,000, when the underlying is at 1,000. We find that these options cost $40. This means that, implicitly, they are pricing a volatility of 30%. We can see that, as we move on the strikes, the volatility of the options is very different. In fact, let's consider the same distance compared to 1,000. For example, consider 140 points below and above 1,000. The implied volatility of the strike 1140 costs 27%, while the implied volatility of the strike 860 costs 41%. What does this tell us? That the market price is more likely a sudden collapse in the underlying rather than a sudden rise. Therefore, the market makers charge a higher insurance premium on the bearish side of the OTM puts than on the bullish side of the OTM calls. Indeed, On the upside they do as well, 4% discount. Many of you will surely know something about historical volatility. It is usually present as an indicator in trading platforms. Historical volatility is nothing more than the average of the minimum and maximum prices of an underlying for a given period of time. So, it is the realized volatility. Historical volatilities at 3 months, 6 months, and 1 year are usually analyzed. The average true range is also an indicator that we find in all trading platforms, an indicator that is made with a similar calculation. Well, if we analyze the volatility that took place over a period of time and compare it with the volatility that the market had priced at that time, we can immediately notice the great advantage that options give over volatility. That is, from the comparison between historical and implied volatility, we note that market makers usually price a much greater fear than what actually occurs. And therefore, they collect money on the expectation of a movement that, as a result, is decidedly smaller than what was previously priced. Thanks for your attention, see you in the next videos.